as an investor, I think you're always better finding a niche and really drilling down into that niche. It could be whatever. It could be Class A luxury. It could be spec homes. It could be workforce housing. Find a niche, find a market, drill down, become an expert in
Mhm.
that, as opposed to spreading yourself too thin.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is your host Ted Patel, and welcome to this week's edition of Decoding Cash Flow podcast. Today we have a great guest, Arn Cenedella, who is a seasoned real estate broker and investor with over 40 years of experience in residential and investment properties. He is a founder of Spark Investment Group and has successfully transitioned from building a single-family rental portfolio to acquiring and managing over 900 multifamily units, mainly in South Carolina. So, Arn, welcome to Decoding Cash Flow. It's a pleasure having you on the show.
Ted, pleasure to meet you and look forward to having a nice chat and hopefully providing some good information to your listeners.
I'm sure. So, and before we get started, or dive deep into your niche, right, your area of expertise, why don't you give our listeners a little bit background about yourself? I know it's a long journey. So let's get started. How did you get started in real estate, and what's your main focus as of now?
Yeah, so typical American kid, grew up in the San Francisco Bay Area, ended up with a master's degree in physical chemistry from the University of Michigan. Never did anything with it. Returned to the Bay Area. My dad had a residential brokerage business in Menlo Park, California, which is next to Palo Alto, where Stanford
Mhm.
is, and spent 35 years as a residential broker. Became a single family investor both in the San Francisco Bay Area, and I was fortunate enough to get into Austin, Texas around 2000.
Mhm.
Moved to Greenville, South Carolina 10 years ago, and about 5 years ago moved to from single family to multifamily, and I now am a multifamily investor, do syndications and joint ventures. So that's kind of the 60-second snapshot of my life.
All right, that's great. So, was there any specific reason you moved to South Carolina, Texas, or it was just a part of the journey?
Just part of the journey. It was honestly more a lifestyle transition.
Okay.
I was 60 years old at the time, had a successful brokerage career in the Bay Area. My life partner, Laura, worked for
Mhm.
Intel, Visa, and Intuit. And we were just kind of ready for a change. Carolinas were attractive to us. Thought we
Mhm.
were going to move to Charlotte, but when we saw Greenville, which is 90 miles from Charlotte, that's where we moved to. So it was more a lifestyle decision. And then, of course, when I got here, moving from the Bay Area, everything looked cheap. And so I started buying stuff in Greenville and then made the decision to move to multifamily. So no grand plan. It was more a lifestyle decision, and then it kind of evolved into what it is now.
Yeah. So, as you mentioned, right, in California and Texas, you're mainly focused on the single family. So, what made you switch to the multifamily? Because, maybe you could
Yeah,
have implemented the same strategy in Greenville.
yeah. So I would say, well, so first of all, being an active investor in single family rental homes is a tried and true strategy. So
Mhm.
not going to discount that at all. It works. It's a great path. For me, I had done it for 30, 35 years, and the single family is kind of more a solitary experience. Uh, yes, you have a property manager, but it's more kind of an individual experience where when you move into commercial real estate, multifamily real estate, what I found, it's more a team experience. You have two or
Hmm.
three partners, and I enjoy the partnership aspect of it. And what it's also allowed me to do is focus on the activities I enjoy and I'm best at. And I'm fortunate to have two great partners who are great at what they do. They enjoy what they do. And it allows me to do what I like best, I enjoy most.
Hmm.
And I know I have confidence in their ability to handle their end. So the multifamily was kind of develop the team thing. And then I guess the other thing is, we all know housing affordability is a major issue, and multifamily apartments are one of the more affordable options. So there's big demand for multifamily, and as a provider of multifamily, that demand is going to be there. So I felt it was a good place to move into from an investment point of view, providing affordable housing. There's a lack of it. So it's
Hmm.
always good to have a product that the supply is less than the demand.
Absolutely. Yeah, and of course, scalability, that's one more thing, right? Yeah,
Yes.
easy to manage, scalability, both.
Yeah, it's great having 30 little income producing units in one location than 30 houses spread out through a county or a market. So, yes, the scalability, the density, uh, the ease of operation is
Yeah,
a big factor for it. Yes.
yeah. And I see your main portfolio, right? It's in Greenville, South Carolina. That's what I saw. Um, have you ever tried to venture out of South Carolina, or you're mainly focused right there and you want to stay there?
Yeah, so that's a great question. So, one of my pet expressions is any investor's competitive advantage is superior market knowledge.
That's
And
true.
people will ask, what's the best market to invest in? And people will say Dallas or Phoenix or Charlotte. My answer is the best market to invest in is the market you know best. So I'm kind of a big believer in local knowledge. We all kind of know within our own communities the feel, the flavor of the neighborhood can vary by block by block. You can
Mhm.
be in a really desirable area, go a half mile away, and it's a total different vibe. So I'm a big, strong believer in local knowledge as an investor. I have two partners. My primary operational partner lives here in Greenville. We know the Greenville market, and so we feel comfortable here. We know the properties, we know the rental values, we know the neighborhoods, and so we're very focused in Greenville, South Carolina. I have kind of toyed with moving up into North Carolina, which I think offers some great opportunities. But what it would mean is I would have to build a new team to handle that. And of
Mhm.
course, that's always an effort that takes some time and there's trial and error. So happy doing what I'm doing now. We do it well. And I think the other thing would be, as an investor, I think you're always better finding a niche and really drilling down into that niche. It could be whatever. It could be Class A luxury. It could be spec homes. It could be workforce housing. Find a niche, find a market, drill down, become an expert in
Mhm.
that, as opposed to spreading yourself too thin.
Yeah, that's a really good advice. And I believe the same. Yeah. So
Yeah,
once you are 100% in your niche, right? Then you can start looking at the other avenues. But yeah, you got to focus first to build your business, scale your business before you
correct.
start looking in the other directions. So now, maybe if you can tell us a little bit about the South Carolina market, right? Especially the Greenville. Like, what do you see in this market compared to the other neighboring states or town?
Yeah, so overall, South Carolina is growing. If you look at in-migration trends, population growth trends, typically the last 3 or 4 years, South Carolina has been either number 3 or 4
Yeah.
within the US. And the only states that are ahead of it are Texas, Florida, and occasionally North Carolina. And given the relatively small size of South Carolina, it's understandable they're not 1 or 2 compared to Texas or Florida. But on a percentage basis, the in-migration is really quite outstanding. And the job growth kind of meets that. In terms of Greenville specifically, we're in the upstate portion, 9 counties, million people. It's in the northwest portion of the state. The other big city is Spartanburg. So within the upstate, we have BMW. Every X car, four-wheel vehicle, every X car BMW makes in the world is built in Greenville, Spartanburg. Don't ask me why. It's kind of mind-blowing, but it's true. Michelin North American headquarters is here. GE is here. Lockheed is here. So we have a strong manufacturing base. In addition, we're on the I-85 corridor that goes from Winston-Salem, Greensboro to Charlotte to Greenville to Atlanta. 120 miles from Atlanta, 95 from Charlotte. And I think most investors understand investing along a major interstate corridor is good. When I started investing in Austin, Texas back in 2000, San Antonio is 45 miles to the south, connected by I-35. When I started investing in 2000, between Austin and San Antonio, it was farm country. Today, it's wall-to-wall people in some of the best markets like New Brunswick and San Marcos to invest in the U.S. are on that corridor. So the presence of the corridor is important. I think logistics and transportation, as we bring more manufacturing back, is going to be big. So there's a lot to like about Greenville. Has a great downtown, fabulous, and we have a lot of folks from New York and Greenville moving to retire. They tend to be high income, high net worth individuals. So there's a lot to like, and there's several economic drivers here at Greenville. So it's been good. I expect it to continue to be good.
All right. Now, talking about the deals, right? Any great tips or to find a great deal in South Carolina? What is your strategy to find a deal? Let's start.
Yeah, it's the same as everywhere, I would say. It's networking, it's getting in front of the brokers, it's meeting with property managers, other investors, and kind of getting to know the players in your market, right? Because as you become identified with a specific niche, deals will flow to you. So I'm kind of all about Greenville, South Carolina. I do a lot of social media on Greenville, South Carolina. So anybody that's building a project or has a property they want to sell, often they're going to reach out to me. The brokers, and we kind of like the sub 100 unit market. I know it goes against the philosophy, go big, bigger's better.
Yeah, everyone has their own strategy, right?
And our little niche is sub 100. We like it. You can get in, you can turn those properties around more quickly, get them operating. So the brokers kind of know the type property I like. They know I close on them. And brokers, of course, want to be paid. So they're going to bring deals to potential buyers that can actually close the deal. So it takes time. And the other thing I find is there's kind of a critical mass. when you're in a certain market, at the first deal's the hardest, and then the second and third, and then it's kind of you hit a critical mass and it explodes. So we're kind of at the point where we're have a fairly sizable footprint in Greenville, and so the deals kind of flow to us. And it's taken 4 or 5 years to get there, but it's just consistent action, networking, talking to people, let people know what you're doing, let them know what you're looking for.
All right. And let's talk about the underwriting the deal, right? What are the specific criteria you use to underwrite the deals? Any thumb rules that you use to, just in a 30 seconds see, okay, this property fits in our criteria now?
Yeah. So uh, one of my partners, Dan Raleigh, is the brain. He's the underwriter. He had 30 years as a CFO. He's great with numbers. So underwriting per se isn't my forte. But I would say kind of quick down and dirty, depending on the age of the property. If it's a 1970s build, you can kind of back of the napkin plug in a 50% OpEx ratio. If it's a newer property, you're going to get to 40%, and in between, it's going to go 40 to 50, just depending. And it's a rule of thumb. It works well. So I kind of do a quickie calculation, 40 to 50% OpEx off market rent. That gets an NOI. Market cap rate here is now about 6. Kind of use that to get a value. And if something's close, then we do a deeper dive. But I think that kind of back of the napkin analysis can save time and eliminate ones that make no sense. The other thing we kind of look at, and it's kind of a single family metric, is 1% rent to price ratio. So if it's $100K a door, rent's got to be about $1,000. Now, when interest rates were 3, you could pay $100,000 for a unit that rents at $800. Today, where they're basically 6, maybe a little more, you really kind of need to make that 1% ratio, and then at least you have a chance to make a deal work. Yeah.
All right. And with respect to the asset management, right? Are you involved in the asset management, or the other partner is mainly?
So I have 3 partners. I'm kind of the deal hunter. I'm the networker. I'm kind of the front man. I raise most of the capital. My second partner, Brian, is the operational guy. So he handles the day-to-day operation, property management, and asset management. Dan handles the financial accounting and modeling. That being said, it's a joint effort kind of to come up with the overall vision of the property, but then within each of those lanes, each of the 3 partners has dominion and can take the ball and run, and they do what they do best. We strategize on the overall game plan, and then let each of us do what we do best in terms of tactics and specifics.
Okay. And maybe I do understand, your other partner is mainly focused on the operations part of it, but
yes.
With regards to the asset management, right? Any specific details like you like to give on how you do the asset management, how you increase the value of the property, decrease the expense, any specific tips?
Yeah. So each property is different, and each property offers different opportunities to increase NOI. So, for example, our last acquisition was a 1970s build, 38-unit apartment. We bought it from the second generation owner, and he was 60. So his parents, who are now, he inherited the property from his parents. His family owned the property for 20 or 30 years. He kept rent on pencil and paper. His rent roll was on pencil and paper. So on that one, rents were below market. So the asset management plan is just to implement professional contemporary property management, bring rents to market. So that's more an operational play. Certainly we'll do some light value add as we turn units. On other properties, uh, maybe they warrant a higher degree of remodel and so forth. So maybe instead of spending 5 to 7,000 a door with kind of a cosmetic remodel, we may go in and do a 25,000 a door remodel,
Mhm.
new kitchen cabinets, granite, brand new baths, etc. So it just kind of varies. We try to make the decision based on what's the maximum rent the market or submarket will handle, and what's the best way to maximize return on investment for our CapEx dollars.
Mhm. All right. And um, you, as you mentioned earlier, you mainly into, networking, getting the deal, and making sure the deal closes, right? Getting all the investments from the investor. So can you talk a little bit about, how do you, what's the main funnel? Like, how do you get all these investors from, what's your strategy,
Yeah. So we have a database. So I was a longtime broker
Mhm.
in Silicon Valley. And so over 35 years, I have a database of investors. And maybe many people in Silicon Valley are stock heavy. They work
Yeah.
for tech, stock options, et
Yes.
cetera, employee stock plans. So I talk to them about diversification. It's not
Mhm.
about moving your entire nest egg into real estate, but maybe you move 10 to 20% of
Yeah,
your
always a good
net
idea.
worth
Mhm.
in. So diversification. So that's a big argument. Uh, Many of our investors are local, and so I meet them through local investor meetups. I'm active on social media. I do a lot of podcasts, and I find that's a way to kind of get my name out there and meet
Mhm.
investors. Uh, Send them monthly newsletters, deal alerts, always available for phone calls. And then what I would say, I'm a big believer in once you get an investor, if you perform for that investor and do a good job and they make money and they get a good return, they'll be a repeat investor. And not only a repeat investor, they'll let their buddies know at work
Yeah.
or at church. And so then you get referrals. So for us, I would say on each of our deals, probably 50% of our investors are repeat investors. Many of our investors have invested in 4 or 5 deals because, as an LP investor, when you find an operator that performs and
Mhm.
does the job, why wouldn't you invest with him or her again? So we spend a lot of focus on performance leading to repeat and referral investors.
Mhm. And I'm sure these all deals will be like 506 C, or is it
We
506 combination of both B and C?
yeah, the great question. So, uh, most of our deals are 4 to 6 million. So we're not doing 30, 40, $50 million deals. So most of ours are actually 506B,
Okay.
which are open to accredited and sophisticated investors. And we actually have a $25,000 minimum. So our model's a little bit different. And I think what operators will find is as the deal size goes up, as the capital raise goes up, you're almost forced to go 506C.
C.
But the scale of ours are kind of small enough that we can go 506B. The other thing we like is I find most people have a positive thought about real estate. They understand owning some real estate's going to be to their benefit, but either they don't have the time or knowledge to do it
Yeah.
themselves, or maybe they don't have sufficient capital. In the San Francisco Bay Area, you're not buying anything with $100,000. I'm sorry,
Yeah.
you're just not. And so, and in metropolitan New York, where you are, it's the same
Yeah.
deal. So I think we like the 506B, smaller minimum investments. We do smaller deals. So it lets kind of first time investors in, and now they become repeat investors. So that's how we kind of approach it, where the bigger operators tend to go 506C because they can advertise. And for them, with the massive amounts of capital they need to raise, that's probably the way to go. For us, the 506B works fine.
Yeah. All right. So,
Yeah.
uh, and you have been in this industry for quite some time, right? So I'm sure you might have come across many challenges, tough situations. If you can let our listeners know about any one of those situations, and how did you deal with it? How did you overcome those situations in real
Yeah,
estate?
yeah. So getting into the real estate business, 1978. I've been through a few market cycles.
Yeah.
I paid 11.75% for my first home mortgage. I sold houses when mortgage rates were 16. Uh, dot-com boom, dot-com bust, subprime crisis,
Yeah.
and I've made my mistakes.
Lots of
Uh,
ups and downs, right?
yes, some ups and
Yeah.
downs. And
Yeah.
what I would say is if you're going to get in the game, you're not going to win every game, right? And
Yeah.
so having some losses is part of it. What I would say is try to minimize your losses,
Hmm.
not make them mortal wounds, right? Live to fight another day. And I think to the degree you can do that, you learn, you gain valuable, and you become a better investor. Uh, so that's how I've tried to do it. And the other thing I would say is when I realize I've made a mistake and perhaps bought something that I shouldn't have bought, I'm willing to cut my losses quickly and move on. I'm not going to throw more money, try to resurrect the deal because my ego won't allow me to say I made a bad decision. I've learned you cut your losses, you move on, and you create that mental and emotional space to find a better deal that's better. And I can tell you, at the peak of the market in the residential market, San Francisco Bay Area, 2004, 5, 6, 7, the real estate market was crazy. As a broker, I was making gobs of money, and I made a bad decision and bought something. And then, of course, the subprime crisis hit, and I was a little overextended. Cost me $100,000 to get out of the deal. Wasn't happy, didn't kill me, learned my lesson. And so learn your lesson, take your loss, and move on and be better. So that's what I would say.
Do you
Yeah.
still do broker? Are you still a broker in South Carolina, or you
Very,
not?
very minimal. I
Yeah.
have my broker's license, but I primarily invest for my own account and for my
Hmm.
syndication firm. So I'm kind of out of the single family residential business. I own a few single family homes and 2 to 4 units in my own portfolio, but the multifamily is all either joint venture or syndication now.
Hmm. All right. And what do you think about the landscape evolving in next 5 to 10 years with regards to multifamily? How do you see it?
Uh, I'm optimistic.
Mhm.
Uh, I've been through numerous market cycles, and typically what I see is 5 or 6, 7 years of boom, and then maybe a year or two of correction, And it's kind of logical and natural. It's the way of the
Yeah.
world. There's ebb and flow. So 5, 6 years, 7 years of boom. Actually, for multifamily, it was actually 2012 to 2022. I think extended to some degree by a reaction to COVID, the printing of money and the low interest rates. So that cycle, boom cycle, may have been a little bit more. Last year or two, there's been a correction. No big deal. As long as you buy properties that cash flow, you just ride it out
Yeah.
and be optimistic about the future. So I think we've just about ended our correction period. I think rates have started to come down, though I don't think they'll come down quite as quickly as investors like us would like. But I think the trend is down. So I think we're now going to enter a period which I call kind of a plateau, a stabilization, which again typically runs a year or two. I think we're just at the start of this stage. And as all the plateau does is set the floor for the next run up. And so in my mind, what logical and natural arguments could be made to suggest the price or cost of housing 5 years from now, 10 years from now is going to be less than it is today? I don't see any arguments you could make that. My thing, the trend, long-term trend is up. I see no reason to change that. And particularly in areas that people want to live, that highly educated people, high income people want to live. There's such a demand for those prime locations. I'm optimistic. And if you invest fixed rate debt, don't over leverage, have ample cash reserves, you can ride out the inevitable rainy days. You just hold, and the value of the property is almost certain to go up. So that's kind of my approach. I realize other people think differently, but that's what's worked for me, and that's how I approach it.
Yeah, absolutely. It's like, there might be cases where one or 2 years, it might dip a little bit, but on the long run, it's always going to go higher. The cost of building these new multifamilies is increasing, and similarly, the old ones is going to the price is going to go in parallel with that.
And cost of labor is going to increase. They say nobody's building more land, so I think that's kind of a good idea. I think the other thing I would say is whatever problems you may think the United States of America has, we're still the strongest economy in the world. Investors from all over the world want to put their capital here because of the economics, but also because of the security of private property rights. And so for people around the world, in China, perhaps some other countries, they're happy to invest here because they have a good sense their capital is safe. And so there are a lot of factors that I think are going to continue the support of American real estate. So I'm bullish, and I put my money where my mouth is. I'm still a buyer, and I actively look to buy every day.
Yep. As long as the numbers make sense, you buy. That's it.
Yeah,
It needs to be
you
positive
have to be
cash flow, and
selective.
that's it.
Yes, you have to be selective. And what the cash flow is for me, and I may be a little different here, I invest for long-term equity growth. I invest for building my net worth because I found at a certain net worth, you no longer worry about cash flow. The money comes. But for individual properties, you need that cash flow. The way I explain it, I want my properties to be self-supporting, meaning I want them to pay for themselves. And the protective cash flow is if you have a little downturn, rents drop, or an unexpected expense, it's still sufficient to pay the debt service, so you don't have to take other money out. And as long as properties are self-supporting, over time, they're going to go up in value. And the only time people really ever get hurt in real estate is when they're forced to sell in a down market And when they're forced to sell, it means they're over leveraged or don't have ample cash reserves. So as long as you don't allow that situation to be created, you sell when the market's right and you can take your profit. In between, you run it, you take the cash flow, and you just keep on trucking.
Yeah,
Yeah.
that's right. And with regards to the exit strategy, right? As you mentioned, you there for the long haul. Is it like 5, 6 years, or you just keep it going as long as you can?
Yeah, so I moved into the multifamily space 2021. So
Hmm.
I haven't exited anything yet. The assets we bought in 2021 and 2022, on average, we have 4% fixed rate debt with another 3 or 4 years maturity. So there's really nothing to do. We're just riding it out. Now, in a couple years, those loans will start to mature. And at that point, we'll have to make the decision, is it a decent time to refinance, perhaps return some capital to investors, or is it a good time to sell? And so we'll just have to evaluate what the conditions are at the time. Uh, Philosophically, I'm a long-term investor. And if you look at people of great wealth, uh, most of them made that wealth through real estate. And I would say most of those people are long-term owners.
Hmm.
They
That's
just
right.
keep buying and holding, and the value goes up. As a syndicator, it's a little different because the compensation comes upon exit. But I think as a syndicator, you can still keep the interests of your investors foremost. And right now, it makes no sense to sell. We'll have those decisions over the next 3 or 4 years.
Hmm.
And we do small enough deals where I think if we decide to hold and refinance, we'll be able to come up with a mechanism where those investors that want out take their cash and profit, we can accommodate. Those who want to continue the journey, we can accommodate. So
Hmm.
we'll work through those details as it happens.
Okay, sounds great. All
Yeah.
right, Arn, loving this conversation, but want to be mindful of your time also. So would like to move on to the final round of questions. Are you ready?
Okay. Sounds good. Yes.
All right. So the first one, which is the one book that had the most impact on your life or on your business?
So I'll give you two. On my
All right.
life and personal growth, it's The Power of Now by Eckhart Tolle. It's an old book, but it
Hmm.
kind of says to the degree you can stay in the present, you're better off. In terms of business, I would say it's uh, Who, Not
Huh.
How by Dan Sullivan, which talks about find partners that excel in areas you don't and team up and focus on your strengths. So that would be my answer there.
Yeah.
Yeah.
Yeah, I've gone through the second book. I haven't read The Power of Now. Maybe I'll just put that on my list.
Check it out. Yeah.
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 All right. So the next question, what are your main source of information to learn and grow?
Uh, I do a lot of podcasts, I do conferences, and I actually pick up a lot on social media. There are several real estate folks like John Burns or Jay Parsons that I follow, and there's a lot of garbage on social media, but there are experts who really provide great content. So I get a lot of content that way. There's people that you can learn from and actually provide solid data that as an investor you can make decisions.
Mhm. All right. What is the best business or investment advice you like to give to listeners?
Uh, so I'm kind of an old school guy, and I believe in foundational step-by-step growth. So I believe in scaling, but I believe there's a systematic way to do it. To the degree you can be systematic, gain experience, gain knowledge, there's a level of security there. So I'm kind of more a slow and steady guy than swing for the grand slam.
Mhm. Just make sure you have the good base before you start scaling up. Yeah.
And when you have the base, then when Murphy's Law strikes, you can actually survive. If you don't have the base, you're on a ladder, you're going to get knocked off. And you don't want that mortal wound. You can take a little bit of wound,
Mhm.
but you want to minimize it. Yes,
That's
exactly.
true. All right. Which is the one habit or routine that has been crucial to your success?
Uh, so I would say one, being authentic, and my word is my bond. As a more practical matter, I get up, I have a light breakfast, and I go do my fitness routine. So for me, getting the blood going, getting the heart pumping, the lungs going at the start of the day kind of clears my mind, gets my energy level up. So it's a routine. I get up, I go to the rec center, and I get going, and then I'm more productive during the day. I have more energy. I'm sharper. I'm not troubled emotionally by doing a little bit of fitness in the morning. So for me, that's my answer.
Yeah. You take care of your body, body takes care of your mind, and mind takes care of your work.
Yes, the body's an amazing thing, and you take care of it, it will take care of you. So
Yeah,
I'm a firm believer in
that's
that.
true.
And
Yeah.
I do a lot of yoga too, and that again helps calm and center me, and keeps you flexible and limber as you get older, which is important. So yeah, I'm
Yeah,
a big
same
believer in
here. That's
that.
my routine also, get
Yep,
up early morning, do some exercise, yoga, and meditation before the start of the day.
correct.
Yeah.
Exactly, Ted.
All right, Ern, how can Decoding Cash Flow listeners get in touch with you?
Active social media, mainly Facebook, LinkedIn, either Arn Cenedella or Spark Investment Group. Website is investwithspark.com.
All right. All right, Ern, it was a pleasure having you on the show. And there was a lot of information that you shared. I'm sure, our listeners will uh, digest it and act upon it.
Thank you, Ted. Pleasure to meet you, and I wish you all great success on your deals up in New Jersey and your real estate efforts.
Yeah. Thanks a lot.
Yep.
Thank you.
Thank you.
Thanks for listening to Decoding Cash Flow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cash Flow, and we'll catch you in the next episode.